then it's getting scrubbed out and banned. And of course, we now know that it's not getting banned. There's no way that Fidelity, Citadel, BlackRock, Charles Schwab, Deutsche Bank, Credit Agricole, Banco Santander all decide they're interested in this, right? They're not endorsing a tulip bulb. So once you go from 0 to 1, then the question is, okay, well, it's an asset class. If it's not going away, then what's it worth? Well, it's worth 1% of the assets in the world. So 1% drives it up by a factor of 10 to 20 once you get to a 1% exposure. So the recognition as an asset class is a big deal. The availability of a spot ETF is a big deal. The normalization of accounting via fair value accounting, which is the FASB initiative, is another big deal. Wall Street and the general community is kind of just internalizing this all in a short period of time, and that's why the bullish outlook. So you're a normal person and you want to save money for retirement or to give to your kids. So you put it in a savings account, you get 5% interest. The monetary inflation rate is 7 or 8 or 9%. You've got a negative real yield of 3%. If you end up with a negative real yield of 3.5%, then over 100 years, $1 million saved is worth $30,000. And so for the average person, saving money in bonds with a 3.5% or 4% interest rate when the currency expands at 7 or 8, that's a losing proposition. You lose 97% of your wealth over the course of 3 generations. So clearly bonds, they don't work, and savings accounts don't work. So the next question is, do I just put all my excess money in the S&P index? Well, traditionally, the money supply in the US is expanding at 7% and the S&P index is going up at 7%. So if you save $1 million over the course of your life and you put it all in the S&P index, then in 100 years, it'll be worth $1 million. So that's wealth preservation, but you're not doing any better than that. And that just kind of assumes that the S&P 500 is going to be relevant for 100 years and you can stick around the country. But it's like treading water. The next issue is what I put in real estate. If you buy real estate, you're an average person. Can you buy a building? Probably not. Can you buy a warehouse? Not easy. Maybe if you're a rich family, you buy warehouses, right? Rich families buy warehouses, city blocks, and buildings, but the middle class person doesn't. So how do you buy $4,000 worth of a building? Can't. Okay, so the issue there is your property rights are inferior when you're buying shares of stock or a security versus the underlying property. If you own the building, you can mortgage the building, sell the building, upgrade the building, build 10 floors above the parking lot that the building has. You can develop the building. When you own a share in a REIT that owns the building, like you own 1/100th of the building, you don't have any of those rights. You can't do anything to the building. You're just along for the ride, getting 1/100th of whatever cash flow the general partner decides to distribute to you. And if they make stupid decisions, you're stuck with them. You don't have any property rights. You're inferior in your economic rights. So owning shares of a REIT to get property for 100 years, not a great idea. And that leads us to the problem of securities. What is the problem of security? So you have some money, you invest it in Apple stock or Amazon or Facebook or Google or a REIT that owns a building. The dilutive problem with securities is there are risk factors. First of all, there's a management team. They're going to take 1% every year. They're not doing it for free. They're charging you to manage the company or the building, right? And if you're lucky, that's only 1%. You want to see that in action? Just go look at any ETF. The ETFs charge 90 basis points. If you want to put money into Bitcoin, Bito, or whatever, they'll charge you 90 basis points just as the management fee. So about 1%. What's the cost of 1% over the course of a lifetime? An infinite duration asset, you would basically multiply it by 20, 25. So it means that when I charge you 1% to manage your $1 million, I'm taking 20% of your money. I'm taking 20% of all your wealth to charge you 1%. So that's only the first problem. It turns out that when you run a company, you also have the risk of labor. Your company may unionize. So you've got labor expenses. And what happens to the equity value when the company unionizes? Well, the union just takes all the profits. And the equity values of those companies start to trend towards zero. So labor is another risk. The third risk is your competitors, right? Your competitor may come up with a better product and you end up like Yahoo squeezed out or AOL squeezed out by Google. Well, then your stock's going to zero. How many companies actually had a competitor? Xerox? Kodak? world's full of great companies. Where are they today? They end up getting squeezed by competition. The fourth issue is technology. You may just get obsolesced, right? Maybe you own natural gas fields or oil fields and someone creates nuclear power plants and they don't need your oil anymore. Or maybe you sell the world's greatest chemical cameras and people don't need cameras anymore. They have digital cameras. There's always that kind of risk from technology. And then there's execution. Maybe you just don't ship the iPhone 47 to be that good, right? Maybe the iPhone 13 is good and the iPhone 15 is not good, right? And the world's full of examples of that, like Firestone tires or something, and I ship a tire and the tire blows out and now people stop buying my tire. Or New Coke. Remember New Coke is a product launch? That didn't work out well. When you're investing in a company, you're not just getting a pure investment. You're actually getting an investment in an asset, but you're getting hammered and diluted by force majeure, by bad weather. You might get a war. You might get a tariff or a trade war. Like we just decided to put a tariff of 20% on all Chinese imports. Oops. If you had a factory in China, what happened there? And then maybe you get a real war where someone just impounds your ship or blows up your factory. That happens too. We have real wars all the time. So what's the return on the S&P index? 7% a year. What's the monetary inflation rate? 7%. What's really happening? Well, all these companies, they're just barely holding their wealth. And so what would happen if I got rid of all those risks? What if I could buy a product that was never going to obsolesce, that's good for 1,000,000 years? What if there was no management team and they work for free, right? What if the product is run by computer programs that don't charge a fee? What if there's no labor? What if it's a digital product, so there is no chance to block it via a trade war or destroy it via a real war? What if it was an indestructible, immortal, incorruptible product? When you buy a Bitcoin, you're buying 1/21 millionth of all the money on the network, or all the money in the world that's ever going to be on that network. Okay, so would you want to own 1/21 millionth of all the money in the world in 10 years, 20 years, 100 years, 1,000 years, 10,000 years? The product's not obsolescing. It's 1/21 millionth of everything. You see, the iPhone will obsolesce. One day you'll be using Apple Vision, or maybe they'll put a telepathic implant in your brain and you won't need phones and you won't need goggles. And maybe you won't need televisions. Those things can obsolesce, but will you want 1/21 millionth of all the energy in the human race? Probably. Like the whole point of pure energy, right? Einstein said, energy can neither be destroyed nor created. You can just transform it. It's a pure idea. It's an idea that doesn't have competition because of the Immaculate Conception. There's one Bitcoin. There's one network that was created by a nameless, anonymous figure, Satoshi, and Satoshi gifted 1,000,000 coins to the universe, never ran an ICO, never kept anything from a pre-mine, and the network now is just owned by the people. So how do you actually compete with that? It's hard to see how you compete with a pure thing like that. So it's a digital monopoly with no labor risk, no war risk, no product risk, no execution risk. Now, there is execution risk that takes place. So you have to set up Bitcoin miners. And if you set up a Bitcoin miner in China and they shut down Bitcoin mining, the miners lose money, but you don't lose money as the holder. It's like the perfect monetary franchise. All of the work to improve Bitcoin is done by the miners, by the Bitcoin device builders, by the Bitcoin banks. You know, BlockFi and Celsius can fail, but if you're holding Bitcoin in cold storage, you don't fail. The hardware company can fail, but you don't fail. And so if you study business, let's take McDonald's. McDonald's is a great business, but the reason they're a great business is so they don't really take that much risk. All the franchises take the risk. And so it's possible for every restaurant to lose money in the McDonald's chain, and the McDonald's Corporation still makes money because they've laid off that risk downstream. Other people risk their capital. So Bitcoin is kind of like this viral ultimate banking monetary franchise where banks will take risk, miners will take risk, individuals will take risk, companies will take risk. When the risks pay off, the Bitcoin holders benefit. And when the risks don't pay off, the people that took the risk pay the price, but Bitcoin just continues. It's very anti-fragile. So coming back to your question, right? How's the middle class family benefit from this? Well, Bitcoin represents pure digital property, global property. It doesn't have the dilutive elements of a security. It doesn't have the dilutive elements of a currency or a credit instrument or debt instrument. It doesn't have the dilutive elements of property. You want to buy a second apartment in Airbnb? Okay, well, fine. Someone may move into it and trash it. You may have a renter that doesn't pay the bill. You may get rent controlled by the city. You may actually have a tornado hit it and trash it. You'll probably get a property tax on it from the city, maybe from the county, maybe from the state, maybe from the government. If you ever have to leave, you can't take it with you. And at some point in 100 years, the thing is probably going to have to be completely rebuilt and renovated to be usable again. So property's not a great long-term store of value. Credit's not a great long-term store of value. They're not scalable. You can't buy $437 of an Airbnb apartment every 2 weeks. So Bitcoin offers you apex global property. Theoretically, if the S&P index yields 7%, there's no reason why Bitcoin shouldn't appreciate about 14% in that environment. I think you get about a 7% real yield over the course of 100 years, whereas S&P index gives you 0% real yield. The best you can theoretically do with real estate property is maybe a 2% real yield if you're just really good at it. But there are just so many risks. Will your grandson or granddaughter be able to run the family property portfolio no matter what country they live in? And are you sure that any of 10,000 politicians aren't going to pass a law to destroy your property values sometime in the next 100 years? Think back from 1900 to the year 2000, and now imagine that you own a bar of gold in the bank in your city. What's the likelihood that you still have it 100 years later? Imagine you have a building in a major city in the world. Imagine you still have it 100 years later. Would you want to own a building in Russia, in Moscow, in Kiev, in Tokyo, in London, in Paris, in New York? Where would you want to own the building? Where would you want to own the bar of gold? It turns out that everywhere in the world, the gold got seized. Maybe you might have got by in Zurich, Switzerland, but everywhere else you lost all your money. Every bank failed, every currency failed. So your best bet is maybe you own property that they can't make more of. If you're lucky enough to own, if you owned a piece of property on the Gold Coast of Florida for 100 years, it went from $100,000 to $50 million. Good, but the property taxes on it probably offset the capital gain from it if it was residential. So the only way you could have actually made money owning property is if you own commercial real estate and you generated a rent on it in excess of the taxes and the insurance and the depreciation and the maintenance. It's not easy to do that everywhere in the world. So Bitcoin represents property rights, or the right to purchase perfect property that is maintainable. It's low cost to maintain. It's indestructible. The rain doesn't melt it. Tornadoes don't destroy it. And it's scalable. You can buy it with your weekly paycheck. So it's liquid. You can sell it. Try selling 1/100th of a building. Not so easy. You want to mortgage the building? The building in Kansas City, you could mortgage to a bank that deals in Kansas City real estate. But if you're Turkish and you have a building in Istanbul, there's only just a small number of banks in the world that will give you a mortgage on that. The mortgage will be in lira. The lira is losing 30 to 40% of its value a year. You got a problem. So Bitcoin represents global digital property. You can take it anywhere on earth. You can hold it for 100 years. In theory, you can hold it for 1,000 years. So you can take a very long view. And how many banks will want your Bitcoin? You see what's going on right now is there's a French bank that wants to custody Bitcoin. There's a German bank that wants to custody Bitcoin. There's a Singapore bank that wants to custody Bitcoin. The banks in the UAE are getting into the business. The banks in Spain are getting into the business. The banks in the US are getting into the business. And on the other hand, none of those banks want to give you a mortgage on your house in Arkansas. Only a local bank in Arkansas is going to get into that, right? So Bitcoin represents a pure economic asset. It doesn't have the liabilities that come with securities and other forms of property and other commodities. And it's simple. And that's why it appeals to the middle class. I don't have a better solution for you if you're a working person on a salary and you want to take control of your own economic destiny.
There's another technology wave taking place. It's a digital transformation of capital. It's digital capital. It's happening right in front of people's faces, but because it's unexpected and it's a paradigm shift and it's an inversion of everyone's worldview, they tend to dismiss it as something random, unlikely, unlucky, scary. Bitcoin's the solution to the problem. It's the solution to the economic problem. How do you win when there's only 7 companies that can win? And it's a solution to the technology question. How do you get on the next technology wave? And how do you exploit it to the benefit of your investors, your family, your company, your customers? Now, how do I know Bitcoin is the next wave? Why should you think it's the next wave? Well, here's a chart of the top 10 largest assets in the world right now. And so if you look at the 10, Bitcoin's number 7. It is the 7th largest asset in the world. Gold's number 1. Then you've got these magnificent 7 companies: NVIDIA, Apple, Microsoft, Amazon, Alphabet, Meta. And you got Saudi Aramco, and you got a little bit of silver. But of them, the fastest growing of these is Bitcoin. Bitcoin is growing 3 times faster than Microsoft. Why is it the next wave? Well, it's not just the fastest growing asset in the world. It's the most popular asset in the world. It's literally the most popular asset in the world. Everyone wants to talk about it. It's the most interesting. It's the most digital asset in the world. You can't digitally transform, you can't move these other assets at the speed of light 1,000,000 times a second between 8 billion computers the way you can with Bitcoin. It's the most useful asset in the world. If you need $1 billion in 5 minutes on a Saturday afternoon, this is the only asset you can liquidate. It is useful to every company on earth, every person on earth. It is global. These other things aren't global assets, with the exception of gold. So, in essence, Bitcoin is the digital gold, but you can't beam gold between 8 billion iPhones, and gold's a 5,000-year-old idea, and Bitcoin is that idea reinvented for the 21st century. And now I'm going to give you a set of suggestions or a set of indicators as to why maybe this is something big, why it's not just random. This is Bitcoin versus that asset allocation chart, and you can see that it looks hard to find a solution when you don't include Bitcoin, and when you put Bitcoin on the chart, it renders every other solution irrelevant. It's pretty clear there's one thing that's interesting and everything else is just more of the same. Bitcoin punches a hole into the chart. 60% over the past 4 years, and if we zoom into that a little bit closer, this is asset performance since MicroStrategy adopted the Bitcoin standard. The S&P's returning 13% a year. Real estate's 10% a year. Gold's 7% a year. Bonds are minus 5% a year. As you can see, the cost of capital, the hurdle rate there is 13. The only thing that's beating it that's conventional is the Magnificent 7, which is a bit more than doubling it. And then Bitcoin is doubling the Magnificent 7. So one of these things is really an overwhelming winner. Bitcoin more than 4 times conventional performance. Let's look out over 14 years. It's the winner in 11 of 14 years. So it's not just it's up over the last 4 years, it's up more over 10 years, 8 years, 12 years. Here's another slice. You can look at everything in the world trying to find something which is more compelling, but Bitcoin is showing annualized performance of 147% from 2011. But again, after Bitcoin, you just fall to like your best growth stock idea. And it's not just that it's the best performing asset, it's the best performing uncorrelated asset. It's got the highest Sharpe ratio, it's also got the lowest correlation. These are fidelity numbers. So the entire world is looking for an investment idea that's uncorrelated to risk assets. You know, we have entire conferences, alternative investment conferences, and we talk about, should it be real estate? Should it be natural gas rights? Should it be intellectual property? Well, Bitcoin is the global, fungible, liquid alternative asset. And you don't have to believe me. You don't have to understand the fundamentals. Even if you don't want to spend 1,000 hours studying it, you can just look at the chart published by Fidelity. It gives you the same answer. BlackRock, they launched a Bitcoin ETF a year ago. That ETF leaped above 1,100 ETFs that they sell to be number 13 in 12 months. So that just shows you how fast it's moving, you know, blowing past 1,000 other ETFs. But it's more than that. That ETF is the most successful ETF launch in the history of ETFs. And I would say if you look at Wall Street over 40 years, the last big innovation in Wall Street was the ETF. The idea that you could buy SPY, or you could buy a portfolio, a QQQ, or a diversified portfolio of assets, that was the big idea, big enough to attract trillions of dollars of capital. And the most successful example of that big idea is IBIT, which has just been a screaming home run. Not only is it run past nearly all of the BlackRock ETFs and all the other ETFs, it's actually outstripped BlackRock's gold fund, which is around forever, IAU, and it did it in 12 months. Digital gold is better than gold. Just like digital photos are better than physical photos, and digital videos are better than your VHS cassettes. It's not a complicated idea. I digitally transform something. It's 1,000,000 times smarter, 1,000,000 times faster, 1,000,000 times more ubiquitous, 1,000,000 times lighter than the thing that it replaced. Many countries, they're not trying to keep their citizens or their companies from getting rich. They're simply trying to keep the capital from flowing out of the company or the country. So it's totally fine for 1 billion people to make an investment that makes them money as long as they keep it in the country in question. And so these ETFs, in many cases, they're handles or they're wrappers, but they're also just solving the problem of how do you be politically correct and how do you be harmonious with all of the regulators around the world. Wealthy families, they're always looking for how to diversify their assets. It's like, I own a bunch of real estate, or I own a diversified portfolio of stocks, or I want some other alternative assets. Well, there's 60 global billionaires that we know publicly are invested in Bitcoin. I give you a short list. But the more important point is Bitcoin is the fastest growing alternative investment for high net worth individuals in the world. And that takes us to the question of what is Bitcoin? Well, Bitcoin just requires a return to first principles. It's a new form of technology. It is economic technology. I think of it as digital energy. But, you know, if you started with this trope and you said, what did Satoshi do? Satoshi discovered a method to transfer value without a trusted intermediary. And people oftentimes repeat that, but that's the small idea. It's not the big idea. Yes, we transfer $1 billion from point A to point B without a bank. The big idea is in order to transfer value without an intermediary, you have to store the value without an intermediary. The big idea is I put the $1 billion into cyberspace forever. The big idea is we launched a payload into orbit. When you launch a payload into a ballistic trajectory, it comes back to Earth. When you launch it into orbit, it orbits forever. When you get to escape velocity, maybe it's never coming back. So imagine the idea that I could put $1 billion into a bank in cyberspace that would stay there untarnished, not corroding, without being debased forever. Like forever is such a powerful idea, right? It's frictionless, it's superconducting. The big idea is store value without an intermediary. It means you transcend banks, you transcend physical laws. This represents a digital transformation of capital from financial and physical assets to digital, pure digital. Like, how much does a book weigh if it's the Encyclopedia Britannica? How much does it weigh when it's a digital Encyclopedia Britannica? One of them is 1 billion trillion times lighter than the other. It's the fundamental phase shift. And now what's that worth? Well, global wealth is divided across a bunch of assets. Here's a $900 trillion wealth chart. People own half those things for utility. They own buildings to live in or work in, and they own cars to drive, and they own companies to operate. But the other half of the assets are just held as a long-term store of capital. You bought it because you had money and you needed to put the money to work. So you have a land bank, you bought a bunch of land, you bought a bunch of commercial real estate, you bought a bunch of bonds. Half of everything is just long-term capital. So if that's what half of everything is, what's the problem? Well, the problem is when you put your money, your 450 trillion into that long-term capital investment, you get hit with taxes, income tax, you get hit with wage controls, price controls, regulations. There's a fire in California, there's a hurricane in Florida, there's a war in Russia and Ukraine. There's a currency collapse in Egypt. There's a bank failure in Lebanon. These are all the things that cause you to lose money. If you're an investor and you've lived long enough, you can probably give me 30, 40, 50 ways you lost money. Most 10Ks have 30, 40 pages of risk factors of just ways you can lose money. There's a lot of ways you can lose in the world. I'm going to call it entropy. I'm going to call it chaos. I'm going to call it the passage of time. Your warehouse just gets older. It was a good warehouse, and 40 years later, it's not a good warehouse. You have to rebuild it. What's that cost? Well, that costs about $10 trillion a year. It's 3% of 450 trillion. It's costing us money to store, I'm going to put $1 billion in your hands, and you got to go buy up everything you want in Asia and hold it 100 years. Then play all these out, and you realize there's going to be an entropic lapse. There's going to be an inefficiency there.